Welcome to Seasons blog. Seasons Q1 recap. What 93 days proved: liquidity, resilience, reliability, sustainability. Crypto has been suffering one of its worst market-wide drawdowns amid rising geopolitical tensions and macroeconomic uncertainty. $540 billion plus have been wiped out of its total market cap in Q1 2026 alone. Bitcoin has shed over 22% since December 2025, while Ethereum and Solana are down more than 31% and 35% respectively. There's also been a steady drain on liquidity. Solana's trading volume dropped from $12 billion plus to about $3 billion in early February, while Bitcoin and Ethereum ETFs witnessed record outflows in the tune of billions. And given this environment of extreme volatility, low volume/momentum, negative social sentiment, rampant liquidations, and overall risk-off behavior, extreme fear has gripped crypto markets for 45+ days as of March 15, 2026, the longest since the 2022 Terra crash. But none of this could hinder Seasons' growth through its first full quarter, 93 days of operations. Between December 9th, 2025 and March 12th, 2026, the protocol generated $1,700,000 plus in trading volume, and 284 nodes, up over 34% since launch, received over $100,000 in yield. Seasons' Q1 performance, as we discuss at length in the following paragraphs, thus proved that the mechanism does exactly what it was designed to do: deliver a reliable, resilient, sustainable, and liquid stream of value for node owners and partners, regardless of the market conditions. Key achievements and overview. Before diving into the value Seasons created and the impact it had in the first 93 days, let's do a quick overview of its top achievements during this time. Seas is now listed across 30+ directories, including CoinMarketCap, and verified on Solscan with a registered chart on TradingView. 6 liquidity pools have been implemented across Radium and Meteora to optimize the token's resilience and support trades at scale. Technical and non-technical measures were taken to make Seas more secure, boosting its ratings across platforms. Our blog has been launched across 4 platforms: Seasons.wtf, Medium, Substack, and Paragraph. And we published our first research report, State of Yield 2026. The Seasons Ambassador and Partner programs are now live, and we have released the alpha version of our partner/referral dashboard to our core community for live testing. Request forms for our inclusion list and angelic distributions are now open to the public, and we're on track to announce our first angelic distribution partner. Through these and other initiatives, both internal and external, we've strengthened Seasons' fundamentals and expanded its digital footprint, optimizing for accessibility and reliability, as well as decentralization and resilience. Yield continued to flow, round after round. Launching with a live product versus vacuous promises, we delivered $28,383 in total yield on the first day of distribution, December 11th, 2025. That was, of course, an outlier, fueled primarily by launch momentum. What's more noteworthy, however, is that node owners continued to receive yield directly in their wallets, round after round. Twice weekly, we distributed yield 28 times until March 12th, without interruption. On Christmas, on New Year's Eve, twice. Through liquidation cascades in global markets and peak uncertainties triggered by economic and military warfare. We never skipped a round or gave any excuses. We didn't need to because the mechanism just worked. In total, the protocol generated over $171,622 in yield, from $1,716,223 in Seas trading volume through Q1. $101,045 out of the total accumulated yield was distributed, with $70,577 available in the pipeline as unrealized yield for ongoing rounds. Seas against the tide. Whereas most tokens bled this winter, Seas grew. From its launch price of about 10 cents in December, Seas crossed 30 cents by the quarter's close, charting a 205% gain against the US dollar. It performed even better relative to majors like BTC and SOL, outperforming them by roughly 235% and 300%, respectively. Part of this growth was structural. Sea's liquidity venues are paired with USD-denominated stablecoins, insulating the token from the cascading cross-asset liquidations that dragged down crypto-denominated tokens throughout the quarter. While leveraged positions across the market unwound violently and triggered sell-offs where everything dropped because everything else was dropping, like toppling dominoes, Seas operated outside that contagion loop. But the price performance is only half the story. The holder base tells the other half. Seas launched with 233 holders. Within 30 days, that number reached 1,486. By the 60-day mark, it had grown to 4,355. And by the close of Q1, 5,686 addresses held Seas. Notably, the largest wave of new holders joined during the market's worst month, not its best. And although the surge correlated with our on-chain campaign on Galaxy, the stickiness of new holders amid market upheaval signaled long-term alignment rather than farm and dump behavior. Moreover, the holder growth was supplemented by a steady increase in node count, rising from 211 at launch to 284. That was a net gain of 73, with 85 new activations and only 19 exits. So, when capital was fleeing crypto at every level, from ETF wrappers down to on-chain wallets, the network of participants who chose to hold 10,000 plus Cs expanded by more than a third. Building the distribution pipeline. In addition to generating yield for node owners, Season's Q1 was also about demonstrating what a continuous distribution pipeline does for projects in its yield payout module. The Genesis iteration of our inclusion list had 5 Solana-based tokens, Peng and Fartcoin, blue chips, each with 25% weightage, $BONK and $WIF, underdogs, each with 20% weightage, JBMB, Rising Star, with a 10% weightage. Over the quarter, the system executed 36,355 acquisition-side transactions, distributed equally across all 5 assets, that is, 7,271 transactions per project. That translated into $25,261 in trading volume per blue chip, $20,209 per underdog, and $10,104 per rising star. Moreover, we acquired and distributed $2.49 billion BONK, $2.6 million Pengu, $67,545 WEF, $91,969 Fartcoin, and $49.6 million JBMB. For dollars, JBJB, that is, the smallest project in the basket, nearly 5% of its circulating supply moved through the season system in a single quarter. And these were neither airdrops that get dumped immediately, nor one-off liquidity injections that fade when the incentives dry out. Being part of Season's inclusion list created sustained demand and recurring buying pressure for every project involved. While nodes earned their yield in a diversified mix of liquid assets, the projects gained automatic distribution to a global network of wealthy wallets round after round. Always liquid, always earning. Most yield protocols impose lockups because they need users' capital for their economics to work. This capital becomes productive for the protocol, but remains frozen for the actual owners. With Seasons, however, nodes didn't, and don't, need to lock up a single penny. If they wanted to move their tokens during market drawdowns, or for any other reason, they did not have to wait in an unbonding queue and watch the price move against them. All of their Cs remained in their wallets, always liquid, transferable, and fully in their control. And the yield they earned? Also liquid, distributed as alternative assets with their own markets, their own demand, and their own utility. Holders could sell the yield payout assets, swap back into Cs to compound their yield, deploy them elsewhere, or simply hold. The system never dictated what happened after distribution. That decision was entirely the node owners. This, however, is a structural choice rather than a concession. Seasons generates yield from transaction fees. So as long as there's movement, which is always there regardless of the direction, there's yield. Sustainable value creation and interest alignment are what keep users in this system, not enforced lockups. Liquidity isn't merely a perk here. It's a design choice we stress-tested in Q1, and the results were compelling. From concept to scale, the road ahead. Q1 was about experimentation, gathering data, refining the nuances of the yield system, calibrating product positioning, and testing the hypothesis under live fire. The hypothesis held, so now the scope widens. Q2 is directed at evolution, while focusing on scaling our user and operator bases manifold. This quarter, we will implement the next iteration of the Transactional Transfer Tax, TTT module, introduce a second yield component, and expand Sea's presence across trading venues. Further, we will also upgrade our brand and resources and sharpen our communications overall to drive maximum impact. We're not building in a vacuum, though, and we're not naive about what's ahead. Season's unique transfer tax architecture creates integration friction with platforms built for simpler token standards. They also create data discrepancies, which we're solving one by one. Moreover, the broader market environment remains unforgiving. Participants are fatigued, macroeconomic uncertainty is at historic highs, and the speculative fuel that powered previous cycles has evaporated. While this presents the perfect conditions to drive the adoption of a liquid, resilient, and reliable solution like Seasons, it also means we'd need to explore creative ways to attract new users and capital. That said, what we're currently facing is more of an exciting challenge than a hindrance. Because one thing is crystal clear from the Q1 data. If Seasons could work so efficiently in some of the worst, most severe environments, it would work in any market condition. Not just that, it's ready to serve as a beacon of resilience and reliability amid globally rising uncertainty. With Q1's insights as the foundation, we're now ready to stride into Q2 and beyond, with more conviction, more data, and a clearer understanding of what needs to happen next. The best part? We can now claim in a voice more resounding than ever. Bull or bear, we don't care. Seize the future. Seize the yield.